Welcome to Framework Fortune and welcome back Framework Fortune community. I'm your host Ben and we're going to go over the EMA strategy that I've been using the last 2 weeks, live day trading the stocks and the cryptos on the Framework Fortune crypto channel. If you haven't subscribed yet to that, go check it out. But let's dive right in. First, what are EMAs? We go to the old wise Google. Exponential Moving Average. EMA is a technical chart indicator that tracks the price of an investment like a stock or commodity over time. The EMA is a type of weighted moving average that gives more weighting or importance to recent price data. Got it now? You understand what an EMA is? Can we end the video now? No, still don't get it? Of course you don't, because what do all these big words actually mean? These are big words and terms that somebody 50 or 100 years ago made up for the stock market. It doesn't matter exactly what this means. All that matters is how to use it. Think of your toothbrush. You don't care where all the materials came from that's in your toothbrush, or the factory, or what state or what country, who the employees are of that place, what those employees had for breakfast. You don't care about none of that. All you need to know for that toothbrush is how to stick it in your mouth and brush it around so you can clean your teeth. That's the part we want to learn. So we know EMA stands for Exponential Moving Average. Nice big technical term. Doesn't matter. You can call it a skittle line if you want. Now these EMAs are data that's being calculated by an AI algorithm. There's not some guy sitting in a room every minute on every single stock trying to calculate all this out. Maybe back in the day, 60 years ago, but now we have a lot of technology that does it for us. So we're not handicapping ourselves by using these. I still think as a beginner trader, it's important to learn price action by trading naked charts, but these will make your day easier. So we actually have multiple uses for these EMAs. The number one use that I use them for is support and resistance. If you don't know what support and resistance is, I have lessons for that. But basically support and resistance are your floors and your ceiling. There's support beams under your floor. If they weren't there, you would fall through it. If you try to jump through your ceiling, you're going to hit your head and fall back down to the floor. So the floors are your support, resistance are the ceilings. Now with stocks, the floor and ceilings can change. If you think about it as an apartment, if you have somebody who lives upstairs above you, your ceiling is their floor. If they fall through their floor, they're falling through your ceiling. So it's the same thing, and it's going to act that same way on the price charts. So if we're looking at this for support and resistance, depending on where the price is in correlation with these lines, these EMAs, is going to be whether or not they are floors or ceilings. The price back here was below all of the EMAs, so of course these are all now ceilings. When it was back here above all the EMAs, these were all floors. And you can see how that works, because when the price dropped, it bounced off of these EMAs, these lines. Just like if you took a bouncy ball and threw it at the floor, it would bounce up. So these are very strong floors because you have multiple of these floors together right through here, right? Instead of just one floor, maybe this green line is a floor, you have all four of them kind of smushed together, so you got 4 times the strength of the floors. And that's why the price was able to hold up there. Now we look back a little further. When the price dropped below the floors right here, the floors became the ceilings. So the price tried to break through here, but there was multiple ceilings above it that it could not break through because they're all smushed together. This is 4 times the ceilings. So it took a while for it to finally break over. So that's why I use them as support and resistance. I don't have to draw a bunch of lines on my chart. These are going to show me a lot of those areas. Now, because these are calculated over a time period, each one of these have their own special number. The green line is the 20-day moving average. So it's going to be the most recent information over the last 20 days, but it's also going to be the magnet for the price of the stock. And you can see that every time that it gets too far below the 20-day, it pulls back. Every time it gets too high above the 20-day, it pulls back. So you're going to be using these for your entries and exit. But what exactly are we looking for? We're looking for the 20-day, the lowest time of EMA, to cross over the highest times of the EMAs. So if this is 20, 50, 100, 200, the 200-day is going to be the strongest support and resistance, the strongest floor and ceiling of all of these EMAs, and it will go from there. So 100-day will be a little less strong, 50-day even less, and the 20-day a lot less. And that's why you see the price of the stock going off of the 20-day quite a bit. And the only reason these moving averages move is because the price of the stock is moving. The price is going up, it pulls the 20-day EMA with it. The price is going down, it pulls the 20-day down with it. But at some point, it will come back. MEDS is not something that I would have been looking for to trade this morning because it had all four ceilings above it. And it did get a nice pop up. And when you have all the EMAs above the price of a stock, it is bearish. You can see where when this ripped really hard, it got pushed all the way back down to here in the 660 area so far. So we're going to look at AMC instead. Now AMC is a little wonky because of all the social media hype and manipulation, but it fits the purposes for this explanation. You can see on this chart that the EMAs are in a different area. Looking back at MEDS, the price is just now above it, but for the most part, it's been below it. Looking at AMC, the price has been above them for a while, and that led to a nice big rip. But the entries we want to look for are the crossovers. So you can see this 20-day was above all of these EMAs back here until right here. And right there you can see that 20 crossed over the other three EMAs. And when it did, it made this bullish. And as long as the 20-day holds up, or you have these other ones close together, like I said, the smashed floors together, that's going to be some strong support. So AMC just rode right across the top of these for a while until it got a big breakout. Now, of course, when it pulled way off of that 20 and it spread these EMAs out, that's going to be time for a pullback. No matter what chart we look at, these EMAs are going to have the same effect. And it doesn't even matter what type of investment it is. This works on cryptos, this works on gold, this works on anything. Anything that can be charted and have EMAs calculated into it, this will work with. So the type of trades I'm looking for are the stocks that are getting above the 20-day EMA, and the other EMAs, these other lines, are in the right place. So we want them from least days to most days. So 20-day, 50-day, 100-day, 200-day. When it lines up like this, that's when you're going to get the biggest bull moves and make the most profits. Now, as you go into a smaller time frame, if we go to the 5-minute on AMC, you're going to see it looks a little bit different. That's because the EMAs on this time frame is a lot less data. We're only on a 5-minute chart, not a daily chart over a whole entire year. So you can see here where the 20-day started to cross over the 50 and the 100-day there. And it did make a nice move up when it crossed, but that 200 was quite a ways off of these other EMAs, so that acted as a ceiling. And the ceiling, the 200-day, is the strongest ceiling or floor. So it got drugged back down, and when the price drugged down, it made the 20-day cross back over to the downside, which led to a big sell-off. Now, once you get that big sell-off, of course, it's going to rubber band back, and it did rubber band back to the 20-day. Tried to start moving again, but got held up at the 50-day. There's some space between the 20 and 50, so that 50 is a ceiling. And it has been getting rejected ever since then. Every time it has dropped below the 20, it's come right back up to it. If I was looking for a play on this morning, looking at it on the 5-minute, I would have not wanted to take this trade for day trading. But looking at AMC, but going back and looking at AMC on the daily chart, I also would not want to take this as a day trade because it's not even close to the 20 yet. I would not want to take this as a swing or a day trade or a long-term hold because it's not close back to that 20 yet. It's pulled down but still not quite there. So it needs to come back down, and these EMAs need to get a little bit closer so that these can act as nice floors together instead of separate floors. They spread out. It's like you have a single family house, you can only go down so far. In an apartment building, if you're at the top floor up here, you can drop through all of these ceilings and get down to the basement. MEDS, same thing. There's no reason why I would have thought to trade this looking at the daily chart here, but if I would have saw it on the scanners on the short time frame, on the 5 minute, we go back to market open, we could see the 20 did cross over the 50, the 100, and the 200. And once it did that, we did get a nice bull move, and you can continue to hold it as long as that 20-day holds up. The moment it cracks below that 20-day, you might want to think about getting out. But if you're holding and it gets way off the 20-day like this, it gets way higher than the 20-day, this actually would have been your sell target. So you want to be buying close to the 20-day as you can, and then you want to be selling when the price is way off of the 20-day. And vice versa, if you're shorting or you're trying to hold long, once you see the 20-day cross back down to the downside, then the price is going to continue down because the price is moving these EMAs. It's dragging it down. So that's showing us that the price action is bearish now. Back here, we see the price action is bullish. It starts turning around. Price action is bearish. And we're able to tell that just by looking at these EMAs. So let's look at a couple of other examples to see how this works. And you can see gold just recently crossed over all the other EMAs. The 20-day crossed above them. So now we are very bullish. This is the type of play I would be looking for. Gold, however, has a huge market cap, so this is not something I would day trade. But the pattern is what I would be looking for. And you see that 20 cross over all of them. Take the entry right around here in this 1800 area, put your stop loss below the 20-day, and then you could just ride this 20-day up till you get off of the green line quite a bit and then lock it out. But you can see where the EMAs are starting to line up perfectly from lowest to highest time. So 20-day, 50, 100, 200. That is what you want to see on the daily. That is also what you want to see on the 5 minute and the 1 minute. So this is bullish on every single chart because the EMAs are matching all the time frames. Whereas if you go back and look at MEDS, the daily time frame EMAs are going to look way different than the 5 or 1 minute EMAs. So that's why I try to stay away from those trades and only look for the ones that are bullish above all indicators. Now on the 5 minute, earlier today gold was below the EMAs, but it was still above all the EMAs on the daily chart. The daily chart is the most time, so that's going to be your strongest data for these EMAs. The 5 minute is not a very long time. It's going to be pretty weak data for the EMAs. So because it was bullish on the daily, on that longer time frame, it was easily able to do another crossover on the 5 minute here and make a nice move. So once it crossed over, you can see how it started going up. Now sometimes you don't have to have the 20 cross over all the EMAs depending on where the other EMAs are at. If this 200 was say up here at 2000 somewhere and you just had the 50 and the 100 right here with the 20 and the 20 crossed those, well then it could run all the way up to that 200. And with cryptos, same exact thing. Here is Ethereum. You can see back here how long ago Ethereum had the crossover. It looks very small back here because of how big this run has been. But the crossover happened back in April last year. And you can see where the 20 crossed over all these EMAs. And once it got above, all those were together, so that held a support 4 times the floors. And the price just kept riding and riding and riding and riding and riding. And it stayed very bullish. Now, even though it dropped right here, the candle ultimately closed above the 20 days. So it still wasn't bearish even though it had a quick drop there. And you can see as these indicators have slowly spread out, the price has slowly went up until it finally had that big explosion. And of course, once it got way off the 20 day and these EMAs got spread out, remember the apartment floors, the price came back down. And that's where we're currently at. And on the daily, the 20-day has been fighting with the 50 on Ethereum. So Ethereum is very close to either going bearish or bullish at the moment. But there's no telling right now. It's holding up that 100-day as a floor. But the 200-day, the strongest floor, is quite a ways down. So this could easily crack this 100-day and come back down to the 200. So what I would be waiting for on, say, Ethereum for an entry on the daily chart is for this 20 to come back above the 50. Now we go into the smaller time frame. You can see currently we're way below all these EMAs and they're spread out to the downside. So it is possible this is oversold now and it could rubber band back. But until this 20 starts to cross over the 50, this will just continue to sell off. See back here, you had the sell off where it was below all the EMAs in the short time frame, pulled down pretty far from that 20, rebounded back up, and the price drug the 20 back above the 50, and then we had a nice crossover right there. And that crossover led to a rip up to 2600. And of course, you're way off that 20, so you're going to be selling up there. So the entries you could have took were possibly here once this red candle pulled back up and this green candle closed higher than the red candle right there. You could have took an entry at 2500, had your stop loss right below it, and then held it up through the rebound and sold it if you wanted to, or continued to hold waiting to see the crossover. And then if you would have done that and waited with the crossover, then you would have been able to pull out some more profit. Now if the 20-day would have hit the 200 and started coming back down, you definitely want to get out. You want to see the crossovers continue to happen. To practice this, go to your charting and start pulling up all different types of stocks and other investments like cryptos and gold and silver, and look at these EMAs, and you'll see what I'm saying. It's on every single chart. These crossovers happen to the upside, you get a nice rip up. The crossovers happen to the downside, you get a nice sell-off, and you'll see it across all the time frames. So you want to look for the ones that are starting to go bullish and starting to cross over all the EMAs, and lock it out when it's way off of that 20-day. So if you still don't quite understand and you have a question, that's okay. Leave it in the comments below. I'll get to it and answer it and try to help you the best as I can. Be on the lookout for the 6,000 sub celebration giveaway coming on both channels very soon. Appreciate everybody joining me as always. Stay safe out there. Until next time.